more than just business news, we're news for business people.
Good afternoon. You're watching Bloomberg Quint. The top headlines. Markets turn wary after another record open. The Nifty holds up above the mark of 10,600. India Wix advances further. And Coal India rises for the second straight session after it approves the revision of non-coking coal prices. 5 strategic investors are likely to submit the final resolution plans for Bhushan Steel, which is undergoing insolvency proceedings. And Apollo Microsystems, the first IPO in 2018, opens for subscription. The defense equipment manufacturer is looking to raise a little over 150 crores. Those are your top headlines. I am Agarwal. Up next is Hot Money with Darshan Mehta.
Thank you, Agam. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Ashwin Agarwal of Newberry PMS, Sameer Kalra of Target Investing, and Avinash Gorakshakar of Joindre Capital joins us on the show. Thanks to all of you for joining me on the show. Today on Hot Money, we'll discuss stocks like Coal India, Arvind, Maruti, and we'll ask them for a long-term pick for 2018. Let's start with the first one, and that is Coal India, one of the top gainers in trade yesterday. A big price hike that was taken, close to a 10% price hike that Coal India took. It was for the FSA price for the lower coal grade was raised by 15 to 18%, but for the high grade coal, it was down by 2 to 5%. So on an average, it was an increase of close to 10%. What next? Most of the brokerages have upgraded Coal India. They're rather bullish on it. Avinash, what do you make of Coal India and this price hike? Now the factor that's already moved up 6-7% from where the price hike has already taken. What ahead for Coal India? Is there more scope for Coal India to move ahead?
I think clearly with this price increase, I think the bigger impact of this price increase would be felt in FY19. I think roughly about 2.5 to 3,000 odd crores of incremental top line would be coming from this price increase. And I think clearly looking at the trend in global coal prices, I think at least in the near term, I think this price increase is going to actually make the sentiment look a lot better for the company. And hopefully, we could possibly also expect another bumper dividend, because normally dividends are another reason why Coal India is into limelight. So I would believe that yes, there could be a little more upside on the stock, but obviously the going forward would depend on how prices stabilize and what kind of production volumes actually come up from Coal India. I think if volumes definitely also grow incrementally at a faster pace, you're going to see the combination of good price increase and a volume increase. So obviously at these levels, I would definitely look at it from a long-term point of view. These could be good kind of price triggers, at least in the near term.
Okay. Any risks that Coal India runs into?
I think the biggest risk is, I think, if there's a follow-on public offer, because I think the government could possibly offer, shares via Coal India as, that divestment targets have to be met. And this could be one of the candidates. And I think if that happens on all probable grounds, it could be at a fair amount of discount. Like yesterday we had NMDC. So I think clearly that could be a little bit of overhang. And how, probably the production ramp up happens, because if on that front, if there is a kind of letdown, then I think the markets would obviously feel a bit disappointed. In fact, last 1 or 2 months, the production volumes have also taken a lot better. So that has also been a soothing factor.
Okay, what about you, Sameer? What do you make of Coal India's news that came out?
So on the news, see, eventually for them, what they estimated that 1,800 crores will come till this FY18, and 6,400 crores roughly come now on the next year, straight to the top line, and then 20% or 15% out of that comes to the EBITDA. So it's a positive news, because see what happens eventually, the wage hike has to be compensated. So it was more of the move that the expenses were growing and they had to somehow manage the price hike to be taken. Now this comes, if you see, from the power consumption side, which are their main clients. It creates an issue over there. And secondly, out here in coal, if you see, they used to have a margin of 26-28% in last 5-6 years. Now that has come down to 14 to 15%. The main problem over there is volume put through. See, eventually the pricing is again dependent mainly on the market dynamics, which are international as well, because a lot of import is still happening. So if you see, there's always a number of these power companies buying the coal for the usage. So around 70-75% is being sufficed by Coal India, which should be 85% or 90%. Then rest is being met through either the imports or through the captive mines. So that is becoming the issue for Coal India as well, because see, eventually they have the reserves, and I think maximum of the market cap is accounting for that kind of reserves. But the amount they are able to take out, because the closed mines they are not able to captivate on, because it's a higher capex kind of a mechanism. So if you take the closed mines, the volume has been flat. The open mines which they have invested 10-15 years back are being utilized for the volume part. So I think the volume surprise will be more of a better re-rater for the stock rather than this one-time price hike.
Okay, so that's the view that's coming in on Coal India. What do you make of it, Ashwin?
So, I'm neutral on it. It's an excellent company. It's a monopoly business in India, very asset light. The main expense is salaries, which the government keeps on increasing. But the problem is Coal India is not allowed to sell coal at the international price. They basically subsidize it for all the power producers in the country. If they did, I mean, the biggest risk in this is that they don't enjoy pricing independence. It's set by the government. So it's basically on the whims and fancies of the government of when they increase the price hike. Like they could take a 20% price hike tomorrow, but they can't because the government won't let them. So that's the risk, but it's a good play for it has a very healthy dividend yield. So I think it's a good stock to invest, but just not a long-term one. You would play it for like a 10-20p move.
Okay, so that's the view that's coming in on Coal India. Avinash is extremely bullish on it. Samir does believe that the move is positive, but there are other triggers for Coal India to play out before actually it starts culminating the returns that it has. And finally, Ashwin is rather neutral on the counter. It's a good company, but at these levels and some monopoly issues is the big concern that he has at this point of time. Moving on to the next stock, and that is Arvind. Stock is trading at lifetime highs. What exactly is happening? What should one do with the company? Is there more room for the company to grow? We'll ask our experts. Ashwin, I'll start with you. What do you make of Arvind?
So basically it's split into two, which is the manufacturing denim, which is their core business and has been. Now that's doing well now, but I don't think that's a great long-term business. It's like a pretty commodity business. Their main value also is going to come from their retail. They've done a bunch of joint ventures like Tommy and Calvin Klein, I think are some of the names that are doing really well. US Polo. So I think the value of the stock lies in how the retail thing performs going ahead. The management has said they're going to delist it, like demerge the businesses. So I would say I'm bearish on Arvind at these prices, but I would look at them once they demerge their retail subsidiary, because I think that's where the growth is from.
Okay, Samir, what do you make of Arvind, both on the manufacturing side and the brand side? And once the split happens, what would be a better play for Arvind going ahead?
So see, there are three companies right now. If you buy Arvind, you get three systems, right? One is the manufacturing, the other is the fashion, which is valued around 8,000 crore as per the last transaction which happened with the multiple P, right? So that has around 3,000 crore revenue, I think, and 2,500 crore debt. And the valuation was around 20 to 25 times forward P. So over there, if I take a standalone branded fashions, it's good. The growth is around 30-35%. But that's when I'm trying to, I rather wait for the delisting and take a share in that rather than doing it right now. The other part which I'm more interested is their engineering part. So somehow it's very small. It's around 172 crores with a 34 crore PAT. So that's a 20% PAT they do. They're into process equipment manufacturing over there. So that is also going to demerge. Arvind, as a standalone out of these two businesses, will face a margin crunch, and it's facing. If you see past 15 to 20 quarters, the margin has been squeezed out. So it used to have a 24, 25 kind of a margin. Now it's running at a 10%, 8% kind of thing. There's a fundamental reason to it, which I think that is taking shape. If you see, its main raw material is again cotton, right? So cotton acreage throughout India in past, especially 3 years, have gone down by 30%. So cotton production, even after using the GM, the BT cotton seed, is still down by 12 to 13%. So prices will be a problem because the hectare is going down. So fundamentally, people are moving out of it. So Gujarat being the major part, he still has the benefit of it. But if overall the things change, the pricing will change because the supply will have a pressure over there. So that kind of a business, I don't want to take a part in it, and especially at these valuations. Sorry. So I'm more interested in the fashion and the engineering part. So I would wait for them to delist and take a part through that.
Okay, so you're waiting for the demerger to actually happen, and once they relist these two separate entries, that is when
I'll be most interested in the engineering part, and the second, the brand and fashion.
Okay, so that's the view that's coming in on Arvind. What about you, Avinash? What do you make of Arvind?
No, I think, as Samir also pointed out, I think the commodity business is the standalone textile business, and there I don't think you're going to see even double-digit growth, 6-7% kind of growth could happen, and I think the branded business is definitely not valued cheap. I think once it gets listed as a focused company, that would be a good call to take, because clearly that is where the management is also upbeat, and probably one sort of re-rating could happen. The engineering business also definitely holds potential, but I think it's still small, and I think probably it could possibly take a couple of years before we see a kind of scale up in the top line and the balance sheet size. So overall, I think as a standalone entity, valuations are more or less caught up after the demerger announcement has been made. So I think the risk reward may not be anything great, but yes, once the units get separately listed, I think that could be a better time to look at individual businesses, especially the retail and the engineering business.
Okay, so that we have three different views that are coming in on Arvind at this point of time, but majority what the focus is that it's a wait and watch till the time all the three businesses are demerged and they're split into and they're listed as separate entities. Engineering as well as the brand business is something that our experts would keenly watch out for going ahead. Moving on to the next stock, and that is Maruti. Now the lifetime high that Maruti hit was almost 10,000, and since then it has been correcting significantly. It's down almost 7% from the all-time high, and every day it seems to be moving down. So what exactly, a few weeks ago there was nothing that could go wrong with Maruti, but suddenly it's hit a bump and it's continuously dropping in trade. So what seems to be the concern for Maruti, and what's the way ahead? Samir, I'll start with you. Maruti, what do you make of Maruti at this point of time?
So I'm bullish on Maruti. I'll give you a fundamental reason to it. See, they had around 1,620 dealers in 2015. In the traditional business, I'm excluding the Nexa or the LCV business, and they were selling around 723 cars per dealer. Now the dynamics has happened that the traditional dealership has increased to 2020, and they are selling around 650 cars per that traditional dealers. And if you see the Nexa numbers, there are 252 dealerships opened of Nexa, which is funded part by the dealer and part by the Maruti. That is selling around 830 cars per dealership. So that is a big jump which they are getting, because that's why even in last 3 years number, if you see, the average car sale price was 3,86,000 ex factory for Maruti. Now it's gone to 4,26,000, and they were earning a profit of 28,000 per car. Now they have done a 46,000 per car. So that has helped through Nexa growth. And I think they are more bullish on the Nexa. So what they are trying to do is whatever cash they have on books, which is a huge sum, they are putting majorly into land acquisitions, and they are leasing out these dealerships to the current dealers. So they are running like a leasing model within the system, because manufacturing any which way has been now given to the Suzuki part. So over there are a lot of cash compounding reasons over there, because eventually see any one company sitting on a 24,000 kind of a cash will always face a difficulty that how should I compound it for my shareholders to win over it. So now their focus is Nexa and True Value. And more they open the Nexa, the quicker these kind of multiples reduce. So what kind of valuations we see today, maybe in next 2 years they reduce, because even if Nexa goes 500 showrooms, in next 2 to 3 years, what they have a growth plan of, I think it will be a more reasonable multiple which will people see. So I am pretty bullish about Maruti on this channel.
Okay. So extremely bullish view. Avinash, what do you make of it? Do you share the same bullish view on Maruti as Samir has?
I think his point was right. I think in terms of the geographical reach, the dealer network, and the kind of product positioning, which Maruti has done, I think clearly they have managed to actually create a niche. And for products like Baleno or maybe the Brezza, there's a strong waiting period. I think in terms of the in terms of the cost and in terms of the EBITDA margin, which we saw in the second quarter, it was around 16.5%. So I think not only volume growth, but even realizations improved by about 3%. So I would believe that, as long as they have a strong volume growth kicking in, coming in. The Gujarat plant is also now obviously operationally ready, and that could also show operationally stronger volume numbers in FY19. So I think overall said and done, this is not a stock which is a trading stock. One needs to take a slightly medium to long term view, Darshan. But yes, I would definitely be a buyer on any correction, and whenever this stock corrects, I think this is a portfolio stock for the next, say, couple of years.
Okay, so it's two consensus buys that are coming in on Maruti. Do you have a buy, or do you agree with them, or you have a different view?
So basically, there's nothing wrong with the company. So I would say Maruti has a great competitive advantage, as in the cars are really trusted by the people, so they've good resale value. All the service centers, you could get Maruti parts anywhere, so it's cheaper to service it. We generally make good quality cars, so there's nothing wrong in the business. Like, it's a very stable business. They have a tremendous market share. It's only been growing. But as an investor, your returns doesn't come by just investing in a good asset. You have to invest in it at a cheap price. So I think currently at what Maruti is trading at, there are a potentially, even though right now there's nothing wrong, at this price I wouldn't be a buyer. So it's purely a valuation call. I would not want to buy Maruti. It's a great company, but not a great investment in my opinion.
Okay, so that's the view that's coming in on Maruti. Two extremely positive views coming in on Maruti, and Ashwin here believes that valuations are expensive, so that is something that is keeping him away from Maruti. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, since it's the start of the new year, we are asking our guests to give them investment advice, to give the viewers investment advice, which are the good stocks that they should have as far as their investment portfolio is concerned. So I'll start with you, Ashwin. Infosys is your bet. What's the rationale?
So
here?
basically, again, it's a good company. Indian IT is globally one of the most competitive places cost-wise. So there's nothing wrong with Indian IT. I think the media reports have been completely overblown. Like, there's not even a decline in sale anywhere. So that's one thing. The valuations are extremely attractive. It's a very high cash generating company, and it's going to start giving back a lot more money to its shareholders. If you see, they've given almost 17,000 crores this year, which is around 8% of the market cap, while most other companies are busy raising money. So that itself shows that the insiders also think that the stock is greatly undervalued. The other thing is about digital. So basically, Accenture and IBM have caught on a lead in digital, but that's the life cycle of any new technology. The innovators first capture a huge market share, then once the product starts getting more and more mainstream, the Indian operators, because they have a leaner cost structure, will start gaining market share later. So I think right now is a perfect time to invest in it if you have a 2 to 3 year horizon. And the best part is there's almost no risk. Like, from a 2-3 year perspective, there's very little chance that you would lose money from these levels.
Okay, so limited downside risk is something that Ashwin is saying on Infosys. That's his bet for 2018. Avinash, Greaves Cotton. So you selected this one. What does the company do? What's the rationale?
In fact, Darshan, I think this is an engineering company which is largely into petrol and diesel engines, and actually has a very large presence in the farm equipment sector via pump sets and gen sets. And I think clearly this is one area which the management has clearly targeted, that in the next 2 years farm equipment is going to be clearly a focus area. In fact, recently they announced a power tiller by the name of Bahubali, which is a locally made product. And I think in the tiller market they've announced great aggressive plans. They say that the market size, which is about 700-800 crores, could possibly grow faster in the next 2 years. And clearly, this focus is definitely good, because on the three-wheeler engine side we saw a little bit of slowdown in the last 12 odd months. So that business is definitely going to take a little while before it picks up. But overall, if you see the capital structure of the business, it's a solid cash generating business. EBITDA margins are close to 13-14%. More importantly, it's a debt free business, and most importantly, the farm equipment focus, as my sense is, not only in this budget but in the next couple of years is going to actually play good rewards. They're also looking at the aftermarket kind of component sales, which offer a better margin. So I would believe that it's going to take a little time. Maybe the FY18 year may not be all that great, but if one were to look at FY19 and maybe FY20, I think this stock definitely deserves a good re-rating, maybe over the next, say, 12 to 18 months. So I think good price to actually get in invested, and probably good risk reward could come in over the next couple of years.
Who are the competitors to Greaves Cotton?
Basically, I think if you talk about most of the engine manufacturers, very few companies actually we have a standalone kind of companies, but typically I think really in the engine category you could possibly
Cummins?
You could look at Cummins, but they are in the larger categories.
Okay.
So I would say that in the farm equipment space, I think probably they are now going to look at VST tiller as a competitor, which is a large player there. But tiller market, I would say, is a small market which could possibly see a bigger percentage as well as an absolute growth, and where the big trigger could come.
Okay. Two quick questions. How are the valuations stacked up for this company? And secondly, do they have any kind of partnerships with any of the auto or tractor companies? Who do they sell to? Who are their biggest customers?
They basically sell to Piaggio, the three-wheeler engines, and they have a tie-up with Tata Motors, clearly for the 1 ton, sub 1 ton and 2 ton vehicles. Clearly, in terms of the tiller market, they don't have any tie-up, but I would believe that they are looking at relationships now with some other private sector players. So obviously, that market is new for them. They've just recently launched a product, so probably another couple of quarters and we could see a better kind of run rate from the tiller business.
Okay, and valuations?
Valuations, in fact, last year they did a bottom line of around 180 odd crores. So our sense is that this bottom line could at least be around 270 to 280 crores over the next 2 years. So roughly about 11 to 12 rupees earnings on a very conservative basis by FY20, which means it trades at around 13-14 times. So which is not very expensive for a company of this stature and this size.
Okay, so extremely bullish view coming in on Greaves Cotton from Avinash. And finally, Just Dial is the stock that you picked, Samir. What's the rationale here?
Just Dial, if you see, past few quarters hasn't been performing really well. The main reason behind was they went too aggressive on the sales force. So they hired like at least 30%, 40% increase within 3 to 4 quarters. The payment and average employee went up to 10 to 20% within the same period. So they went really aggressive on the employee spend, which actually hurted their margins. See, eventually the main capex or the main opex which they need is the employee. The more field force they have on foot, is the more better the listings they have and more paid customers they have. Since then, last 2 quarters they have been started to rationalize it. Last quarter, if you see, the margin jumped up from 14% to 20%. 20% was the average margin which they used to attain. So 26 to 30 is the highest peak of that margin. Now, since the numbers have been depressed in last 3 to 4 quarters, the valuation itself has been depressed. Now what is happening is, if you see the numbers, earlier they were more on the voice inquiry systems. So now within last 2 years, that has degrown from a 15% of traffic to a 6% of the traffic now. And the mobile penetration, the app downloads, have gone to a 6 million to a 17 million per quarter. Okay. So that has jumped in last 2 years almost 3 times. if you see the unique visitors, which is the most important parameter by any startup or a technology company, new age tech has been parametered by, that was 75 million per quarter in past 2 years. Now it's come to 105 million. So that's a big jump. So the main constraint for last 3-4 quarters was always the employee expense, which was suppressing. So now that has gone out of the space. The volume, the more customers they get from mobile, the better the OPEX or the operating leverage kicks in.
Okay.
So I think that will be a very good kind of a investment today for next few years.
Okay, so extremely positive view on Just Dial coming in from Samir. So the 3 stocks that have been recommended by a guest. Let's have a quick recap of which are the stocks that our guests have recommended for the 2018 picks. Okay, Ashwin, Avinash and Samir, thank you so much for joining me on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg.